Welcome to America's Commercial Real Estate Show, your source for market intel, forecasts, and strategies. Hello, I'm Michael Bull. Thank you for being with us. This segment is brought to you by CommercialAgentSuccess.com. Check it out if you want the ultimate in commercial real estate broker training. Learn more at CommercialAgentSuccess.com. Well, we have a great show for you today. One of the things that really impacts commercial real estate, really performance and obviously values in transactions are the availability of financing for the tenants, for the acquisitions, for the refinance. And of course, there's a lot of questions leading into 2023 here where we are as to what's going on there with banks and other lenders. Well, please welcome my guest. It's Jamie Woodwell. Jamie is head of commercial real estate research with the Mortgage Bankers Association, and they have just come out with their 2023 Commercial Real Estate Finance Outlook Survey. Jamie, thank you for joining us, sir.
Yeah, my pleasure. Thanks for having me.
Well, thank you. And I think the first question that might be on the minds of our listeners and viewers are kind of rate expectations really is, when you do the survey and you look from your position there, do you really expect rates to continue to rise a little bit? Here we are at the end of January 2023. And then did you expect them potentially to come down a little bit afterwards? What's our expectations there?
Yeah, I mean, rates are maybe the $4 trillion question right now when it comes to commercial real estate debt markets. And we just this morning had some information come out on CPI, on the inflation front, which of course is a key driver for the Federal Reserve and what they're thinking in terms of their path forward on rates. And I think when you think about rates, you need to really divide the short end of the curve from the long end of the curve. And the short end of the curve is absolutely being driven by the Fed and where folks expect the Fed to be going with rates. And they've been signaling that they're going to continue to put the brakes on the economy to try and get inflation under control by raising the Fed funds rate and then holding it up probably longer than the market expects them to. So a little bit of a tug of war there on the short end of the curve between what the Fed is signaling and what the market is really expecting. We can talk more about what inflation is doing and how that may play into the Fed's hands. But on the long end of the curve, I think you've got a different story, which is that if you think about where the 10-year Treasury is and how that affects mortgage rates, it's looking not just over the next year or two and what the Fed might be doing, but really over the next decade and where rates are expected to go there. So that's why you've got this situation now where the yield curve is inverted. You've got 10-year Treasury has actually been coming down a bit over the last half year or so. So expectations that we have at the Mortgage Bankers Association are that 10-year long end of the curve is going to continue to tick downward. That as we start to see inflation getting more under control, as the Fed sort of works through what they're doing, that the upward pressure we've seen on those long-term rates will be trending down. So that should be a positive. Again, short end of the curve, a little bit more volatile because it does depend on the Fed's sort of actions month to month that we're going to be seeing over the start of this year.
Yeah. And we've all been kind of intoxicated over the last several years with these really low rates. But when you look at the rates where we are now and you look at kind of historic rates, are we really too high? Or are we more kind of market average?
Yeah. I mean, if you look over a long term, rates are low historically. Compared to certainly if you're going back to the 70s, 80s. If you look over the last decade, the long end of the curve is a bit high. So if you look at loans that are in existence versus where rates are now, most of those loans will have been made at a lower interest rate than what's out there today. So that's one cause of some concern for existing loans and what they'll face when they come to refinance. On the flip side, we've seen incredible growth in property values over the last 4 or 5 years. We've seen growth in income. So that all can balance out some of that increase in the rates that we're seeing over the last 6 to 8 months.
That's a good point, and it makes sense when you look at the stability of commercial real estate and multifamily real estate. There has been a lot of equity buildup, and I lead a team that sells office buildings, and we're selling some buildings at cap rates that sellers would have thought was way too high a year ago. We're selling some at 8 and 9 cap rates, but the sellers are making money. They're doing well. To your point, they've had strong appreciation, and they're realizing they've been in business a long time. That these rates aren't going to drop down to 0% again, to 3% or whatever again for their lifetime. They think so. It's interesting. Now, I think most of our listeners will be familiar with the Mortgage Bankers Association, but they're the largest lender association in the country, and they've been around since 1913. And then you have the the largest lenders that are most active, and you've done this survey. Tell us about when you did this survey and how it's done.
Yeah, sure. So every year at the end of the year, sort of looking ahead, we do a survey of the leaders of the top commercial and multifamily mortgage origination firms, just to get their sense of where the markets are and their outlook for the coming year. So we asked them questions sort of between Thanksgiving and Christmas, and then we released it right at the beginning of this year, sort of looking out at what are the key themes and trends for 2023. And just to set the stage, one of the questions we asked was whether the respondents, the leaders of these firms, whether they viewed today's market as sort of settled or unsettled. And every single respondent said that when they look at today's commercial real estate finance markets, it's either unsettled, very unsettled, or somewhat unsettled. So when you look at where they're starting those views from, it's really a place where the market is trying to figure out what's next.
Right. And what were volume expectations for the loans by the respondents?
Yeah, so pretty much everyone expects volumes in 2023 to be down this coming year. I don't think for any individual capital source, a majority of respondents expected to see an increase in 2023 over 2022 volumes. Our own forecast, we're expecting sort of 7 to 10% drop in originations activity in 2023. What you see in the survey too is that the leaders of these firms do expect the market to firm up over the course of the year. So if you look at Q1, vast majority still expect the market to be unsettled. But by the time you get to the fourth quarter, a majority of folks think that we will be in a far more settled market. And by 2024, really everyone expects the market to be back on track.
Yeah, well, that's good to hear. And do we have more demand for loans than we have lenders, or where are we there?
Yeah, so that's a place where oftentimes we see that we'll see that there's a stronger demand for deals than there are lenders available. Here, we're seeing a fall off in that, and one of the things that we're going to be keeping an eye on is oftentimes you see transaction activity and mortgage originations really tracking very closely. The same things that drive people to sell a property or buy a property also drive people to refinance or finance their property. We're thinking that may not be the case the end of 2022 and into 2023, that transaction activity has really fallen off dramatically. We think that originations will fall off dramatically as well, but perhaps not quite as much, because there is some debt available. We can talk more about where it is, but to the degree that projects do pencil out, there will be a lender out there looking to make that loan.
Yeah, I think it's an interesting time. I think these may be some of the safest loans that the lenders will do in the last decade. When you look at, if a property is stable enough to put the proper loan on it now, you don't have to worry about, the higher rates at maturity, and you probably in some really good loans, I think. And I know there are a lot of lenders that are active, right?
Yeah, that's right. I think lenders have money they want to put out, and they're working through what are the deals that can support a loan. And so that's looking at the interest rates and where they are, looking at cap rates, looking at some of the uncertainty in the economy and where that might be going and how that might affect different properties or property types. So if a deal does pencil out, and if it can support that loan, I think there are, just as you said, a good number of lenders out there who are ready, willing, and able to make that loan.
Yeah, and we look at banks as a lending source. They're in pretty good financial shape, right? And are the are the regulatory agencies, Fed, whomever, what are they saying to these big banks about commercial real estate loans?
Yeah, I think you're seeing the banks have had a strong appetite for commercial and multifamily mortgages. Actually, our mortgage debt outstanding analysis that we do each quarter, it's available up on our website. When you look at the third quarter of 2022, you saw banks sort of take on net more commercial and multifamily mortgage debt than any capital source has in any quarter since the series began. So we're seeing strong appetite there still from the banks. Regulators always look closely at commercial real estate, particularly at banks that have concentrations of commercial real estate, and so that's not stopped. They've got a special eye on office loans and sort of what might be happening in the office market. So the examiners will be bringing that in along with their overall view of sort of bank capital levels. And again, if there are any concentrations, banks that have concentrations in commercial real estate, which includes construction activity as well as permanent loans.
Yeah, that's it's interesting. We closed three loans on office properties in December. We have two loans closing now on office properties. So there are still lenders out there doing deals. What types of lenders do you think will be most active in 2023?
I think 2023 is going to be a story of two halves, is our hunch. That the first half is likely to remain a little bit muted, particularly as folks work through that uncertainty still. But then the second half, we are expecting to see a little bit more firm of a market and to see activity pick up. Really there's the whole range of capital sources out there, right? The banks continue to be the largest source of commercial and multifamily mortgage debt, really across property types. The GSEs, very active in the multifamily side. They're expected to continue to do that this year. If you look at life companies, they are steady in terms of their activity. Again, they're always assessing both how a commercial mortgage compares against other places they could put their money, and also looking at the market and where they feel comfortable putting that. On the CMBS side, you've seen a very active single asset, single borrower part of the market. The conduit side that tends to do smaller, sort of more traditional commercial mortgages has been a bit quieter, certainly the end of this year and coming into this year. So really a whole range of different capital sources that are out there, and each has its own sweet spot, and each will probably be working into 2023 again with an appetite to put money to work and just figuring out which are the properties that can support it.
Yeah, we're talking with Jamie Woodwell with the Mortgage Bankers Association, and Jamie, with your experience in this world and researching it all the time, and you just the survey just recently came out. Was there anything in there that kind of piqued your interest or surprised you or kind of jumped out?
Yeah, it's a neat survey, and so if folks are interested, they can go up to our website and check out the release of it. It's a mixed world right now. I think the two big takeaways for me are, one, that we are in this period right now that's really unsettled, but again, expectations are that that's going to start to work its way through. And then when you look at the topics and what are the things that are leading to some of that consternation or slowdown in the market, really you can put them in three buckets. I think there are questions about the space markets and supply and demand for space, and each property type has sort of a different story there. There are the equity markets and sort of questions about valuations and how to value a property, where are cap rates today, that sort of a thing. And then there's the debt markets, and with the rise in rates from where they were at the beginning of 2022 to where they are today, basically doubling in just that base 10-year treasury rate. So you've got changes going on in all of those, the space markets, the equity markets, and the debt markets. And to sort of work through where we are, you have to process the changes that we're seeing in all three of those. And so the survey really highlighted that each one of those markets, there's some questions about it and some uncertainty that lenders and originators are working through.
Right. And investors nor lenders like uncertainty, but certainly opens up opportunities for some lenders to get into some good loans and good borrowers that maybe they wouldn't have had a shot at before. What advice would you give lenders who are listening as they go into 2023?
Yeah, I mean, I think lenders. One of the beauties of the market is that we've got a really strong set of lenders out there who have had experience through a variety of different environments, and so they're bringing that experience to bear. There are questions about the existing books of business that are out there and sort of loans that are maturing. What's going to happen with those? And then also there are questions about adjustable rate loans, and sort of as they come up for adjustment with higher rates, how do their debt service coverage or other elements sort of work in this new environment? So lenders are working through that, and just as you said, looking for the opportunities. So to the degree there's been a lot of equity that's been built up over the last 5-10 years, that's going to help those properties come up to a refinance and, again, maybe not get quite the proceeds that they would have gotten back a year ago, but hopefully still be in a place to pencil out, put the new loan in place, and sort of move along.
Okay. And let's reverse it. Let's think about the borrowers out there who maybe they have a maturity coming up, or they're just looking for some financing. What tips would you provide them?
Yeah, so there was a great book I read back a number of years ago, and of course I'm going to forget the title right now. But the key takeaway was "Be here now." That sort of you need to accept the current environment, think about sort of how things fit now, as opposed to what life might have been like a year ago or where you thought things would be going. And so I think for borrowers, if you look at your current situation, if you look at where the markets are today. Again, there's a lot of equity that's been accrued. There's been a lot of increase in property NOIs, and sort of working through today's market and looking for those opportunities, given what's changed and what hasn't.
That's an excellent tip. Yeah, I like to tell folks, look, you want to make decisions looking through the windshield, not the rearview mirror. Right?
I like that.
Look at where we are. There's a lot of opportunities, and we can't look back and cry on our beer about not getting 3% interest rate loans, right? They're gone, everybody. There's a new day. Cap rates have adjusted, and I think we're seeing some pricing discovery. I was speaking at a appraisal convention recently, and of course, one of their questions to me is, Michael, where are we on cap rates and pricing discovery, and how do we get some recent comps? So I think we're starting to see that. So hopefully things will kind of smooth out here. Jamie, thanks for joining us, and thanks for sharing the information.
Yeah, absolute pleasure. Thanks for having me.
All right, thank you. If you'd like more information from Jamie and the Mortgage Bankers Association, their website is mba.org. Thank you for joining us. And if you'd like to go to our website, it's creshow.com. Until next week, be sure that you always lead, learn, and laugh, and join us for America's Commercial Real Estate Show. Appreciate the show? Consider referring business or doing business with our sponsors. Bull Realty is a commercial real estate sales, leasing, and advisory firm doing business throughout the Southeast, headquartered in Atlanta. Visit bullrealty.com for more information. Commercial Agent Success Strategies provides video training for commercial agents. This training gets 5-star reviews from even the most experienced brokers. Learn more at commercialagentsuccess.com. CREF.com. You're invited to connect with us on your favorite social media. You can find us on LinkedIn, Facebook, and Twitter. Don't miss a show of special interest to you. Be sure and subscribe to the show on YouTube and Apple Podcasts. And at the show website, CREshow.com, you can subscribe for a weekly email announcing the show topic and guest. While you're there, you also found more videos and podcasts. Thank you for watching or listening to America's Commercial Real Estate Show.